The S&P 500 just hit 6,920 points, and something wild is happening in the markets right now. The Fed just cut rates in a 9-3 vote, the most divided decision we've seen in months. And while the Dow exploded 500 points, AI stocks are suddenly cooling off hard. But here's what nobody's talking about. Searches for something called Kalshi just spiked 7,000%. Stay with me, because by the end of this, you'll understand why this rate cut might be the most controversial move of 2025 and what it means for your money. December 10th, 2025. The Federal Reserve announces a quarter-point rate cut. Sounds boring, right? Except 3 Fed governors voted against it. 9 voted for it. That's a split decision we haven't seen in years. The markets went absolutely crazy. Watch what happened to the Dow Jones that day. The Dow rallied 500 points in hours. The S&P 500 jumped nearly 1% by December 11th, closing around 69.20. That's a 14.35% gain year over year. But here's where it gets interesting. The Nasdaq didn't follow. Tech stocks stumbled. AI companies that were flying high just months ago suddenly hit turbulence. Look at this chart showing AI stock performance versus the broader market. So why did the Fed cut rates if the economy seems fine? That's the controversy. 3 Fed governors said no because inflation's still sticky. But the majority pushed it through anyway, citing what they call mixed labor signals. Now, you might be wondering what mixed labor signals even means. Let me show you the employment data they were looking at. Non-farm payrolls came out December 16th. The numbers were all over the place. Some sectors added jobs, others shed them. But here's the kicker. The Fed made their decision before these numbers even dropped. They were working partially blind because a government shutdown in November created massive data gaps. They literally didn't have complete information. Think about that. They cut rates without seeing the full picture. Now here's where the market gets really interesting. While big tech cooled off, small cap stocks surged. Value stocks, the boring, old economy companies everyone forgot about, they're suddenly hot again. This chart shows the performance gap between growth stocks and value stocks over December. It's flipping. Why? Because lower interest rates help smaller companies more. They borrow money to grow. Cheaper borrowing means more expansion. But AI companies? They're getting crushed by their own valuations. Investors are asking, are these companies actually worth what we're paying? And the answer increasingly is maybe not. Look at this data on AI stock corrections. But remember I mentioned Kalshi at the start? Here's where things get wild. Kalshi is a prediction market platform. Basically, people bet on real-world events, elections, economic data, Fed decisions. And searches for Kalshi exploded 7,000% in December. Why? Because people are desperate to figure out what's coming next. Traditional markets feel unpredictable, so they're turning to prediction markets for answers. And Kalshi isn't alone. Searches for embedded lending. That's when non-bank companies offer loans directly, also spiked. Something called Ominimo, a niche fintech tool, is trending. People are hunting for alternative financial instruments because the traditional playbook isn't working anymore. This graph shows search volume trends for these emerging fintech terms. Let's zoom out for a second. The S&P 500 is up over 14% year over year. That sounds great, but peel back the layers and you'll see serious cracks. Housing markets are stalling hard. Home delistings, that's when sellers give up and pull their homes off the market, jumped 45%. 45%. Sellers can't find buyers even with rates dropping. Check out this housing market data. Why? Because even with the rate cut, mortgage rates are still elevated from where they were a few years ago. Plus, home prices haven't corrected enough to make buying attractive. So you've got this weird standoff where sellers won't lower prices and buyers won't bite. The market's frozen. Meanwhile, small businesses are jacking up prices. 34% of small businesses raised prices in December. Why? Because their costs aren't dropping even though the Fed cut rates. Labor's expensive, supplies are expensive, rent's expensive. So they're passing it to consumers. This inflation pressure is exactly why 3 Fed governors voted against the rate cut. Look at this small business pricing data. Now, Black Friday happened December 1st, right before the Fed decision. Consumer spending data came in strong. People were buying. The Fed saw that and thought, okay, the economy can handle a rate cut without overheating. But here's the problem. Black Friday spending doesn't tell you about January or February. It's a one-day snapshot. Using it to justify a rate cut is like checking the weather at noon and deciding what to wear all week. Let's talk sectors. Healthcare stocks gained ground in December. Why? Because they're defensive. When markets get choppy, investors hide in healthcare. People always need medicine and doctors, regardless of economic conditions. Energy stocks were mixed. Oil prices bounced around on global supply concerns. But the real story is the rotation out of tech and into everything else. This sector performance chart tells the whole story. And we can't ignore policy. President Trump's tariff threats are hanging over the market. Companies don't know what trade will look like in 2026. Will there be new tariffs on China? On Europe? Uncertainty makes businesses hesitant to invest. That hesitation trickles down to hiring, spending, stock buybacks. The market hates uncertainty more than bad news. At least with bad news, you can price it in. So what does this leave us? The Fed cut rates in a divided vote. Stocks rallied initially, but AI cooled off. Small caps and value stocks are having a moment. Housing is frozen despite lower rates. Small businesses are hiking prices. And people are flooding into prediction markets and niche fintech, trying to get ahead of what's next. The 7,000% spike in Kalshi searches isn't random. It's a signal that traditional market indicators aren't giving people the confidence they need. Here's what to watch in the coming weeks. First, inflation data. If prices keep climbing, the Fed's rate cut looks like a mistake, and those 3 dissenting governors will look like prophets. Second, watch small cap performance. If they keep surging, it confirms the rotation out of mega cap tech is real. Third, keep an eye on housing. If delistings keep climbing, it signals deeper economic stress that rate cuts can't fix. The S&P 500 hitting 6920 is a headline number. But underneath, the market's telling a complicated story. It's not just stocks go up, economy good. It's a tug of war between sectors, a Fed making controversial moves with incomplete data, and investors searching for new tools to navigate the chaos. That Kalshi search spike? That's fear and opportunity colliding. People know something's shifting, and are scrambling to position themselves before the next big move. The question is, are you ready for what comes next? If this breakdown helped you see beyond the headlines, hit subscribe. The market's not slowing down, and neither should your understanding of it.